Have you ever wondered how economists take the pulse of a country's economy? Well, it turns out it's not just about what we produce. It's also about who earns what. Today, we're going to pull back the curtain on the income method, a fascinating way to see exactly how a nation's economic pie gets sliced up and served.
So here's our game plan. We'll start with the core idea behind it all. Then we'll dive into the three main pillars of income, see how they all get put together, cover the super important rules of what to count, and finally, wrap up with why this whole thing actually matters.
All right, let's get right to the heart of it. The entire income method is built on one really elegant idea. For every dollar of stuff we produce, that same dollar has to end up as income in someone's pocket. It's a perfect circle.
And this cake analogy nails it. Just imagine a country's entire economic output for 1 year is one gigantic cake. Now, instead of just measuring how big the cake is, the income method asks, who gets the slices? The people who did the work get wages. The owners of the land get rent. The people who lent the money get interest. And the entrepreneurs who took the risk, they get the profit. And here's the kicker. The value of all those slices has to, and I mean has to, add up to the value of the entire cake.
Okay, so to make this work in the real world, you need a system, right? You can't just count every single paycheck. So economists have a blueprint. They group all the income in an economy into three big, distinct categories. We're going to call them the three pillars.
And here they are. First, you've got compensation of employees. That's basically all the money earned from working a job. Second is operating surplus, which covers income from owning property and running businesses. And third, we have something called mixed income, a special category for self-employed folks. You add these three up, and what you get is the total income generated inside a country's borders, or its domestic income.
Let's start with the biggest piece of the pie by a long shot, compensation of employees. This is the total reward, and I mean all of it, that employers pay their employees for the work they do.
Now, this is where it gets really interesting, because compensation is way more than just the cash that hits your bank account. Of course, it includes wages and salaries, but it also includes what we call payments in kind, things like a company car or free housing. And crucially, it also includes the money your employer pays on your behalf into things like Social Security. All of that is considered income you've earned.
All right, on to Pillar 2, operating surplus. If that first pillar was all about income from labor, this one is all about the income you get from owning things and from taking business risks. In other words, property and entrepreneurship.
And this pillar also has three main parts. You've got rent and royalty. That's income from owning land or maybe the rights to a resource. Then there's interest, which is what you earn from lending money. And finally, you have profit, the reward for actually running a business. This covers everything from the corner store to huge government-owned companies.
Let's zoom in on that profit part for a second, because it's not like it's just one lump sum of cash. Before anyone sees a dime, a company's profit gets split three ways. Part of it goes straight to the government as corporate tax. Another part gets paid out to the shareholders. We call those dividends. And whatever's left over, that's kept by the company as undistributed profits or retained earnings to reinvest and grow the business.
And that brings us to our third and final pillar, mixed income. This is a really clever category that's designed to capture the earnings of all the self-employed people out there.
So, why do they call it mixed? Well, think about a doctor with her own practice or a guy who runs a small shop. Their income is a jumble of everything we just talked about, right? It's part wage for their labor, part rent for their office, part interest on their equipment, and part profit for being an entrepreneur. Since it's nearly impossible to pick those apart, economists just bundle it all together into this one mixed income category.
Okay, we've got our three pillars. Now for the fun part, putting them all together to get that big headline number, national income. And it's actually a pretty simple two-step process. Step 1, you just add our three pillars together, the compensation, the surplus, and the mixed income. That gives you what's called net domestic product at factor cost, which is just a fancy way of saying all the income earned inside the country. Step 2 is going from domestic to national. We just need to add the income our citizens earn from other countries and subtract what foreigners earn here. That little adjustment is called net factor income from abroad, or NFIA for short.
And there you have it, the whole blueprint in one picture. You can see how those three pillars flow together to make up domestic income. Then you make that one little tweak for income from abroad, and bam, you've arrived at national income. It's a really logical and clean structure when you see it all laid out.
Now, to make sure these numbers are accurate and aren't just nonsense, economists have to be super strict. They follow a set of golden rules that decide what gets counted and, just as importantly, what gets left out.
The most important rule is this: we only count income that comes from this year's production of goods and services. That means we have to exclude things like pension payments or unemployment benefits because no work is being done in return right now. We also exclude illegal activities, obviously, and things like capital gains from selling stock, that's out too, because you're just transferring ownership, not creating anything new. Same goes for selling a used car. Its value was counted way back when it was first built.
But, and this is the cool part, there are a couple of fascinating things that do get included. So, while the value of that used car doesn't get counted again, the commission the dealer made from the sale does, because that's a payment for a service they provided this year. And here's a really clever one: the imputed rent of homes that people own and live in. Economists actually estimate the rental value of all those homes and add it to the national income, because that house is providing a valuable service, shelter, even if no rent check is being written.
So after all that math and all those rules, you might be asking, why do we even do this? What does this number actually tell us? Well, it tells us a whole lot. It's way more than just a number in a textbook. For starters, it gives us a fantastic snapshot of income distribution. It shows us how that national cake is actually divided. You can see how much is going to labor versus how much is going to capital. Seeing that breakdown helps governments and economists understand inequality and design better policies. And on a more practical level, it gives us another way to calculate national income, so we can cross-check it with other methods and make sure our overall economic picture is as accurate as it can be.
So, we've seen that measuring an economy is about so much more than just the total value of what's produced. It's about understanding the complex web of earnings that flows from everything we make and do. It really is about knowing not just how big the cake is, but who's getting a slice. It's something to think about the next time you hear a big economic number in the news.